Hello and welcome to a new episode of Quantaraxia's Market Dashboard. After a pretty interesting week, the week that actually started last weekend after the strikes by the US on Iran nuclear sites, where after that, everyone was expecting the market to tank and collapse, but the ceasefire happened very rapidly, which allowed the market to bounce back very rapidly like nothing happens, and the S&P finishing the week on a new all-time high. So let's dissect this and see what happened this week. So again, S&P strong rebound, new all-time high, which is usually a strong signal for the market, and I'll talk about this in relationship to gold. We have the activity ratios that are going down both on the S&P and bonds, so the market is quieter now than it has been in a very long time. And we actually, reached some lows, specifically on the S&P. And another indication is that both S&P and bonds were rising together. Another sign of a low correlation that we get now between the S&P and bonds. We see that again at the end of the more towards the end of the video. But the big loser this week was, of course, oil, which dropped significantly after the rapid ceasefire intervened between Israel and Iran. And basically oil is back to square one at this point from where it started. It had an impact, a pretty severe impact on some managers. Some famous manager got hit by the whip. So I've seen this on the Bloomberg news this week. So many were caught off guard, and we'll go into that. Again, another illustration of what happened. So you see the drop here. You barely can see the impact of the war on the S&P, whether you look at the prices or you look at the VIX itself. So it's barely visible. When the drop was about, the big drop that we had recently in April, March, April, was due to the tariff sequence. So here are basically what tweets can do to the S&P 500 and the VIX, and what a potential global war can do to the S&P 500 and the VIX. S&P 500 in blue and the VIX in the area in red. So you see, it's kind of crazy, if you ask me, to see that what impacts the market and what doesn't. I often say that markets tell you everything you need to know. What does it mean is that it can mean two things. Is that, people just don't care about any new war in the Middle East. It's kind of, a regular situation since basically 2001. Or they never actually believed that this conflict would escalate into something meaningful, into something serious. So we can see the same thing basically on the greed fear index. The first salvo of tweets about the tariffs by Trump, which sent the market down, and the greed fear index into fear region. And then, when we had some, clear issues on the bonds market, then another tweet, salvo of tweets saying, pause on the tariffs and we'll see what happens, and the market, bouncing back very hard at this time. That sent now this greed fear index into the greed region. And comparatively, you look at what war happened, it barely moved the index at this point, which remain basically neutral. Just for the record, this greed fear index is one that I calculate myself, but is in many ways very similar to what you can find from JP Morgan or Goldman Sachs or whatever. All these indices, greed fear indices, are built in the same way. So again, the losers of the weeks were commodities. So oil, it's an obvious de-escalation from the Middle East. Gold is a little bit different story in my opinion, and I talk about this again when I will address gold directly. So this is oil here. So you see that oil was already rising before the conflict. It spiked up on the 12, what we call now the 12 days war, and then when the market opened, the futures market opened on Sunday night. So after the strikes, then the oil slightly spiked again, but not. Very interestingly, not massively and rapidly. It was clear that the situation would not escalate. With talks about ceasefire, Trump calling for a ceasefire very rapidly. The Iranian retaliating by notifying in advance the US that they would strike this base. So basically nothing happened. It was, again, the retaliation was a communication operation. And then just because everybody knew that this would not go anywhere, the oil started going down pretty significantly to get back to where it started, basically. So we're kind of back in the narrative that was prevailing before this war, where we will go back into the narrative with tariffs. That the pause of tariffs is supposed to end on the 9th of July. But this is unlikely to restart because we've heard that there were some signings, some trade deal signs between. So yesterday it was between China and the US. We have no detail, but it was announced yesterday. Trump and EU said they were really confident to get signed deal pretty rapidly before the 9th, and tariffs going back to much higher levels. Trump also talks about deals with India. So at least for now, we've seen that, with a couple of tweets, it can change very rapidly. The situation seems to be de-escalating globally. So we'll see where we go from there. Now, yes, so that is gold. So why did I want to talk about gold specifically? That was down on the week, and specifically yesterday. I believe there are a couple of reasons, because if you think about it, a major contributor to the narrative of gold going up was the US deficit. And that situation didn't change. With the big, beautiful bill, the situation of the US deficit didn't change. It might actually get worse. So the rationale behind gold going up actually didn't change. What actually changed is a couple of things, in my opinion. First, market reaching new all-time highs. This one is pretty strong signal usually for equities, and when we had money moving from risk on assets to risk off assets, like gold, with a strong sign such as this one on equities, we may have another move, a counter move from risk of assets like gold to risk on asset. It's not always where the price are going, is sometimes, and actually very often, where the money is going. So is the money going away from risk on asset to risk off assets? Or, if people are expecting equities and risk on assets to go up, this will trigger a move away from risk of assets. But again, it doesn't mean that it changed anything from the rationale that took gold where it is today. So at the same time, there are a couple of, we have the Fed. Inflation is slightly up. The core CPI that the Fed is looking at is slightly up. At the same time, the employment is down. So the Fed will have to choose between higher rates or low rates, depending if they want to control either inflation or they want to push employment in the US. And we've seen this week that a couple of Fed members have called for the Fed to be more dovish and push the employment at the risk of pushing inflation again higher. So that will be something to monitor, and that will be obviously something that will have an impact on gold. You see that we just closed on basically the short-term upper trend. I don't look much at this, but I think that this was a nice setup. So I just draw this rapidly. Anyways, what can we say? That the US dollar is weak again and has been declining against every other currency in the world at this time. You see that the US dollar has been going down since the beginning of 2025. So, and this is Bitcoin. So Bitcoin reacted similarly as oil, but on the opposite side, obviously, where you had Bitcoin dropping on Monday and then recovering over the next days. To be close to the all-time highs as well. Again, I would agree that Bitcoin is behaving like a risk-on asset at this time. There was a time where basically it was doing its own thing independently from equities or bonds or gold. Today it's can probably more categorize it, at least in terms of relationship with equities, correlation with equities, to a risk-on asset at this time. And even though it didn't reach new all-time highs, it follows the same pretty similar pattern, I would say. So now, if we look at the activity ratio, I think what's interesting is that to notice that the activity ratio of the S&P is collapsing totally to pretty significant lows, in my opinion. Levels where it doesn't stay very long. Does it mean that we'll see more activity coming? That could be the case if on two occasions. That could be the case if the ceasefire is not respected in the Middle East and Israel and Iran are going at it again. That could obviously lift the activity on the S&P. And the other one would be a totally new kind of Goldilocks environment where everything looks beautiful and the market is going up pretty significantly. We've seen that the S&P positioning of traders on the S&P until recently was pretty short. So if the market would go up, many of them will have to cover their position and basically run after the rally, and that could push that rally higher if that actually happens. The other thing is the opposite is oil activity rising, which is basically based on the volatility that we've seen recently on oil on the upside and on the downside. So we see that basically all asset classes except oil, again, which is naturally considered what we've said before, all asset classes activity as measured by volatility ratios from short term to long term are going down. So the situation is getting really way quieter than it used to be over the past months on the market. I wanted to show you this, which is something that I've shown you before, which is the risk-adjusted momentum. So basically, it's a 1 year. It's an average of multiple time range between 3 months and 1 year momentums divided by short-term volatility. So this means that this is a risk-adjusted momentum indicator. And what I was finding interesting is that two things. First, the total collapse of the US dollar in terms of momentum. We've seen that we've been a very clear downtrend since the beginning of the year. We are reaching new 1 year 1-year lows, that kind of levels, and so the risk adjusted momentum is collapsing pretty rapidly for the US dollar at this time. But I think that the important thing is to see the risk-adjusted momentum in the S&P rising and getting back at the front of the train for all the major asset classes. The S&P is clearly the best risk-adjusted momentum over a year, and this is kind again of an indication of what the CTA, commodity trading advisor, trading momentum could be, because they are, so their signals is based on momentum plus an assessment of the risk, and so this means that for the ones that didn't come back to the to be positioned on the S&P, will probably come back, specifically if they are a little bit longer term and they have a longer lag to the market. Then seeing the S&P risk-adjusted momentum getting stronger and stronger will force more people into the market. I wanted to show you this because we are back where we kind of were in, I would say, normal situations, the new normal between the tech sector and the other sectors. You see it's the relative performance here between the various sectors and the S&P 500, and you can see that when I say that we are back into the new normal situation is that most of sectors are underperforming the S&P 500, and the only sector overperforming the S&P 500 is the tech sector. So again, the one that is lifting the S&P 500 at this time is the tech sector, and this is why I say it's kind of the back to the new normal. And yes, this is the last thing I wanted to tell you. That I mentioned at the beginning of the video. So we've seen that in a week where this could be discriminating between risk on and risk off asset, we've seen that both the S&P, both equities, US equities and US bonds are going up at the same time. In a week where this could be really separated, then this one you should see a clear difference between the two, and they are both going up, which means that there's no much decorrelation left between US equities and bonds, and this is what we can see here on this chart. We see this chart from 2008, so this is pretty recent. This is not a long-term 50-60 years chart, but this shows that over that time span, the correlation was negative from at least from here 2008 up to 2022, mid 2022 kind of, and then become positive. And this signs the death of the 60-40 portfolio, even some risk parity portfolio. Why? Because for the 60-40 or the risk parity portfolio, what you need for that kind of portfolio to work is two things. You need to have both equity and bonds more or less giving the same performance, which actually happened between 2008 and 2020. And you need some decorrelation, which again happened between here 2008 and mid 2022, I would say. And both these conditions are not met at all. So not only you have one asset that is very underperforming, massively underperforming the other assets. Your bonds is in a 40% drawdown when the other one is making new highs. But at the same time, you don't even get the decorrelation from the bonds in your portfolio. And that signals the death of the 60-40 or even the risk parity portfolio. You could accept that bonds are underperforming if this would give you diversification and lower the global risk of your portfolio. This doesn't happen anymore, and this has consequences in terms of the risk on the equity markets because, again, people will go away from bonds and reinvest probably into more performing assets. So if you want diversification, you potentially have gold that may take the place of bonds inside the portfolio. Some people that are less risk averse may bias their portfolio much more toward equities, which makes equity markets riskier. Because you have a herd effect basically when everyone will be selling and buying at the same time. And not only this, we've seen the concentration in the tech sector, which means that it's getting again even more concentrated and more risky. So all of this to say that if the 60-40 and the risk portfolio are at least in terms of bond plus equities is dead, there are some alternatives. Many of you have heard about the permanent portfolios, the Harry Brown, or even the GAFCAL portfolio that says, okay, you should mix basically a permanent portfolio of equities, bonds, and gold. I think they are better and sexier solution than that, but that's not a story. So I wanted to finish on this. Again, this was a very interesting week that started with a bang and finished with another bang, which was yesterday a new all-time high on the S&P 500 on US equities. We are living very interesting times that will now potentially switch back to the end of tariff story if we are, like Trump announced this week, deals signed between major countries, meaning the US and China, the US and the EU, and potentially the US and India as well. Thank you very much for listening. If you have questions, don't hesitate to put them in the comments below, and I'll see you next week. Thank you.